Welcome back to Bootstrapped, the lighter side, where we talk about the forces shaping capital, companies, and founders. Today's guest is someone who's seen the global financial system from one of the most important seats in the room. Marc Verissimo is the former chief risk officer at Silicon Valley Bank, where he spent years thinking about systemic risk, economic cycles, and what can break when assumptions change. I think it's important to say that Marc left Silicon Valley Bank in 2016, long before the bank's troubles in 2023. And Marc is also, we're so fortunate, the chair of Lighter Capital. Today, we are going to talk about the current economic landscape, tariff and trades, political shifts, and most importantly, what all this actually means for founders and operators trying to build durable SaaS businesses right now. Welcome to Bootstrapped, the lighter side, the podcast for B2B startup founders wanting to achieve success without giving up ownership or control. This podcast is brought to you by Lighter Capital, the leader in founder-friendly financing for B2B SaaS companies. Learn more at lightercapital.com. Marc, welcome back to the show. It is always great to have you here. I think that when we speak with you, it's typically our most popular podcast. So thank you.
Yeah, thanks for having me on.
And before we jump into the headlines, and there have been a lot lately, I'd like to ground this in how you look at the world. You've spent your career managing risk at scale. So when you look at today's economy, what's the first thing you pay attention to?
Well, you have all the standard items you see. If you Googled something or you chat GPT, they put GDP, unemployment, inflation, interest rates, all these typical things. What I tend to focus in on more, I look at the 10-year bond yield because that gives me some sense of what the debt providers are looking at the economy, what they think about the future. I look at job creation, and that's non-government because, again, government jobs don't add value to the economy, value in the way we look at it. And I look at labor participation of people, who can work, whatever, how many are working. And right now, I thought it was higher in the past, but I think the most recent past, Clinton economy sort of hit 68, 69%. And currently we're at 62%. So the question is, what's that 7% that's not working? And again, if they're working at jobs, and we still have 7 million open jobs. So yeah, it's not 12 million where it was, but it's still 7 million. So there's still plenty of jobs out there. And then there's various reasons why that might be coming together. And then productivity gains. Because again, when you look at how an economy is doing wealth-wise, and particularly with our current debt situation, we're going to need productivity gains to continue to prosper and hopefully do much better going forward. And again, productivity was very high in the early part of the 20th century, and it started to slow down towards the end of the century. And it's, sometimes been pretty meager as we started the 21st century.
And of course, the big topics, it's interesting, are kind of the big topics that we had a year ago, which is AI and, again, tariffs. Tariffs are in the news lately. Yeah. So specifically, as we look at SaaS companies, Lighter Capital Fund SaaS companies, and we're in the middle of what is supposedly a SaaS apocalypse, how should we be thinking about AI and tariffs in relationship to SaaS companies?
Well, with SaaS, and again, I'll say that there's a wide variation of outlooks and what people think. But what I found more compelling, particularly regarding SaaS companies, was that direct AI, or quote unquote, now they're calling agents of AI, they need data, and they need data to explore. They need data to be trained on. And you look at most of the SaaS companies, they're basically producing that foundational data in there, whether it's a Salesforce or Slack or any of these various tools that you use. So I look at it and say, I think SaaS companies are going to be needed, because right now the AI doesn't do the actual data. Now, why you're seeing reevaluations of the value of the SaaS companies is how that they can monetize it. And so what I'm hearing more and more is that you're going to see sort of an overall, you're not going to have, at least some people believe, you're not going to have individual AI engines for each SaaS product. There'll be an overarching AI, an AI agent that does it. So Salesforce coming out with their own AI, all these individual ones, I'm not sure that's going to allow them to increase their market and increase their revenue share with the client. I think they're still going to sell their base product, but there may be an overarching AI that does that work. So I think that's where you're starting to see some of the evaluations in the stock market. And they were pretty somewhat high valuations to start with. So they're bringing down sort of the total available market over the longer term form. But I don't think they're going away. Tariffs, SaaS it's tougher because it's not actually physical goods,
Right.
Per se being moved. And particularly for a lot of companies that we may be working with, I don't think it's a huge issue for them versus auto companies and some of these where there's more heavy metal being delivered.
Most of our companies aren't directly affected by tariffs, but their customers are. So that could change demand and willingness to pay for their products. But getting back to AI, you, as the head of our investment committee and credit committee, we've had a lot of discussions on this topic and how it will affect SaaS companies. And I would say, and jump in if you see this differently, we were probably more concerned a year ago than we are today, when the fear was we will see large churn among our customers as companies just decide to create these products themselves or have AI create these products rather than spend money with SaaS companies. But in fact, so far we haven't seen that at all. So far, the primary effect that we have seen is that our companies have just become more efficient because they're able to grow without adding costs or even cut costs in some cases and still grow. And we haven't seen this mass movement to our customers, deciding they're going to create their own healthcare management system instead of contract with a SaaS provider to do so. But do you think long-term that's a risk? And if so, what is the timeline?
There could be a couple risks. One risk is, does my current product rely, let's say, on Google searches and how people are currently searching for products? And there, I think they need to be cautious. How will AI affect that when it becomes fully implemented? Now, partially right now, what's going on is listening to somebody they're putting basically it's a system on a wafer. So you no longer take the wafer, chop it into chips, you just put it all on one wafer. And it's the CEO of Cerebras. And their issue is right now it takes you go into a chat GTP or something, you ask them a question, it takes some time. You go to Google, you get almost instantaneously, very quickly. So there's a time lag there. And their job is to reduce that timeline down to, something that we as humans will take a couple seconds, 5 seconds, not a minute and a half, not 3 minutes, not 4 minutes. So what he says is once we get that done, then there'll be a massive shift towards AI. So as a customer, you just have to be, how's it going to affect me? And the timeline may be a year or two off because clearly they're just coming out with their wafer on a thing in June. And then who knows how long it takes after that. The other is just for the SaaS customers in general. It seems like, that they constantly, I'm trying to keep with all the new names. There's a Kimi, there's all these new agents coming out there. And I've heard of, an agent coming out, I think it's Kimi, that basically they give it access to everything.
Yeah.
All their databases, all their emails, everything. And then they're saying it's helping them manage the business at the CEO level, down to the manager level, giving them access. Now, the issues there is security,
right?
And cybersecurity, and this data is going somewhere. Which paradoxically, when I talked about Cerebras and bringing into the data centers, you're now seeing some real thoughts about going, well, we originally back in the 60s, we had dumb terminals and we had big computers. And then the PC revolution flipped that on its head. And also we had distributed power out there. And then Amazon, whatever, shared resources, started to build these big data centers, and you started to rent out, spaces in them. Now they're saying with large language models, let's say I'm a large insurance company with a lot of proprietary information on fires and costs, et cetera. Do I want that going into a large language model that then, basically pierces and everybody gets it? Or do I want to keep it proprietary to myself? Which means then it's a flip back to, I've got to own the data processing in my own house. So it's a flip back to that where I'm going to have to spend money then. And
going back to out of the cloud and on-prem, right?
Yeah. And so, on-prem. And so you're going to get cost efficiencies from AI maybe, but then you're going to lose them as you're doing all this infrastructure to build it. So it's still pretty fluid out there. And again, as a business owner looking at that, you just have to keep up to speed as to what's going on there. Again, for SaaS, again, being foundational to the data, I don't see it harming them that much, unless something comes out of left field that I'm not aware of. But I think all the AI is going to need those foundational systems. And you just have to make sure your APIs are up so that they can get to them. Because I think you're going to have requests for the companies to say, I need to get into that data. And I need to let the AI get into that data. And then you just need to work with the customer to understand the privacy, the security issues, et cetera. So maybe is OpenAI the best way to do it, or do you want closed AI that means you can have the security you need?
We were talking about earlier, we hear so many mixed signals. I mean, you touched on this, but we have strong employment in some areas. It certainly doesn't feel like strong employment in tech compared to, 21 and before. It doesn't feel that way, but the employment numbers are still strong. But we have tightening capital and others, especially in venture, when it comes to SaaS companies. I mean, SaaS companies, especially in the last month, saying they can't get funded. Even really high-performing SaaS companies with, growing 100% year on year are having trouble raising venture. And I think that's largely because venture capitalists right now are worried about terminal value. Valuations have gone down, so it's difficult to invest in this asset class. They all seem to have switched. A year ago, everybody was still focused on SaaS companies. But we have persistent inflation concerns, and there's geopolitical risk layered on top of everything. Going to the inflation side, we provide capital to companies in Australia where we have a warehouse facility, and we have the same in the US with different providers. And our cost of capital is dependent on, in the US, it's SOFR, in Australia, it's the BBSW or the bank rate. We just had Trump is saying we're going to lower rates in the US, and in Australia, we just had a rate hike of 25 basis points. So we've got two countries looking at the world very differently. Would you dare to predict what SOFR will be at a year from now? And we're focused more with our business on the short term.
I'll combine this with something with GDP expectations, et cetera. If you look at the CBO, the GDP expectation, particularly the last one they put out there, they have it maybe going to 2%, over 2% this year, maybe next year, and then dropping down to 1.8%, which then you've got this huge increase in our debt, over the next 10 years. If you listen to some people, they're thinking, oh no, we're going to see 4% GDP growth this year, maybe even 5% GDP growth because of stimulus from the tax refunds. And you could say, we're still pumping in $1.5 trillion of extra liquidity in there. We've got all this AI boom. We've got some manufacturing coming back. So they're saying there's all these positive things going on. So my issue is if you see all that going on, and if productivity increases dramatically, then I could see rates coming down some. If it does increase dramatically, stays, pretty tame, then I'm thinking, no, rates might stay, although they're never stable, but they might stay, where they're at, because I'm going to have, if I'm seeing 4 or 5% GDP growth, what's unemployment doing with that? Is it a Does it stay flat because a lot of this, because we're getting so much productivity growth, we don't need all of that. But to me, it's always tempered by, I remember Marc Andreessen saying, they were talking about job losses and AI, and he says, listen, almost half the economy is housing, education, and government. All three are highly regulated, and there's not going to be job losses. They're going to regulate the heck out of it to make sure it's not. So he says, then you're talking about half the economy, could see some job losses. And again, scar tissue of living through the 70s and early 80s. I'm not sure we're going to see big decreases in short-term rates. The long end might move up a little bit, simply because I don't think he's going to be as active on the mortgage buying side of it than he was as he tries to bring the balance sheet down.
So we're hearing flat to slightly lower, but we're not going to be back into 21 levels anytime soon.
I don't think so. Although when I say flat to lower, clearly there's a few governors that think we have to start thinking about rate hikes. So
yeah,
on the table. But rates have helped the dollar, so the dollar has stayed relatively okay because of the higher rates.
We touched on this a little bit earlier, but we've seen a dramatic pullback early in the last month with venture capitalists financing SaaS companies in particular. And venture capitalists have pulled back since 22, but we started to see some pickup last year. Yeah. But now I can't find a venture capitalist that invests in SaaS companies. Yeah. There's still a few out there, but most of them have said we're into deep tech or agentic AI. And if you're a SaaS company and you think that you're going to need dilutive funding or venture funding for growth versus non-dilutive funding, if you have revenue, you have access to non-dilutive funding. Yeah. How should you be thinking about this? Do you think this is a temporary movement by VCs, or have they really switched and they're just not going to be funding SaaS in the near future?
Yeah. Having been in this since the early 80s, I've seen definitely the VCs, a herd mentality that I've seen over the years with VCs. You could in the late 90s, you had the internet, and you just had a herd of companies go in there. Then it just dropped off a cliff, and nobody wanted to talk about the internet. In fact, some people were saying we shouldn't even call ourselves Silicon Valley, call it something else, because that's such a big name. Then it comes roaring back in different areas, different views. So yeah, if I'm a SaaS company, I think if my premise that AI is going to have SaaS data sources, then I would say, it's just temporary, meaning at some point they're readjusting. And VCs, they always say they look out 5 or 10 years. I looked at what's the stock market doing today. And they tend to freeze like everybody else freeze, even though intellectually it's saying, no, when everyone, it's Warren Buffett, when everyone is scared, I'm aggressive. When everyone's happy and aggressive, I pull back.
And greedy when those are afraid, and afraid when those are greedy, right?
Yeah. And it's history in venture capital. The few people or firms that have done that have done very well at the troughs. But if I'm a SaaS company, do I find that 1 in 50 venture capitalist? Or fortunately, there are debt providers out there, Lighter being a prominent one, that can help you get through some of these issues and not have to, one, try to find somebody, and second, if you do find somebody, not do it, extremely dilutive to you and your company. So I think it's temporary, maybe a year, 2 years, but you have to be able to get over the chasm.
Let's talk a little bit about just political shifts and general economic confidence. With political changes, both here and globally, they seem to be happening faster and with more volatility, especially in the last year. From a former risk officer's point of view, how do political shifts translate into economic risk? And how should we be thinking about what's, a pretty volatile political landscape when we're assessing economic risk?
When I look at the situation right now, and I don't know whether it's unappreciated risk or whether people are really factoring this in, but I think political risk, now in political, I'm saying, what's regulations, what's policies, what are they trying to do? I think that risk is heightened over the last 10 to 15 years because we've seen dramatic differences. And let me give you an example. One is crypto. They started talking about like 2013. They were talking about it, and some individuals were trying to make sure let's get a U.S. regulatory overview of it so then we can do it. During the first Trump administration, there was some movement doing that. And then Biden administration came in and just wouldn't even want to talk to the crypto people. I had a CEO of one crypto company saying I was trying to talk because I didn't want to be Tether. And Tether's the crypto that's offshore, mildly or no regulation. And he said, no, I wanted the US regulated product to come out. He said, I couldn't even get a Biden official to talk to me. And then there's this thing, and then, people being unbanked. And Andreessen made a big deal about this, that there was crypto founders, et cetera, that were just being unbanked. And now it's come out, there's been some emails and memos that the administration was doing that. Then Trump comes in and we get the Genius Act, which is meant to, let's bring that here. Let's make the US a big player in crypto and in stablecoin and all that. So it's a huge change for it. And you don't know what's going to happen in 2028, or even 2026 when we get another, Congress in there. So, and then, for the auto companies, they were just getting beat upside the head about fuel efficiency and you got to go electric. And so they poured billions of dollars into this. And now you have the Trump administration coming in allegedly with their scientific panel and their scientific thing and saying, well, no, we don't have to do some of these things that you're doing. And all of a sudden Toyota looks more like a genius because they kept the hybrid, which seems to be the popular thing. So if I'm, a business, I'm just trying to figure out the tea leaves. And that's why I think policy is so important, because as everything else, everything's politicized. So you start to see these things about what's the inflation rate in a red state versus a blue state. And right now, it's, for 25, it was 2.5% in a red state, 3% in a blue state. Well, why is that? Well, most of it is energy. Blue states is 5.2% in 2025, and red states is 3.5%. A lot of this, the mandates, there's no, green energy is not a free lunch. In California, I think they try to push it through as a free lunch, but it's not. Employment, you look at employment growth, same way. It tends to be more focused in the red states than the blue states. So again, if I'm a business owner, I have to, just adds a little bit of complexity and maybe even cost, because I've got to stay nimble to say, okay, right now the government's telling me this is what they want. But unfortunately, in 2 years, it could be something else. And here I'm trying to do a 5-year plan or something like that. It makes life pretty difficult. So for me, that starts to become, risk that ranks up there with cybersecurity, AI, the rest of them that I have to deal with. Problem is that the modulation is getting wider, meaning a Trump leads to a Mandami, so very, very different economic outlook, view of the world, and the policies of both sides are tending to exacerbate, the issues that we have right now, and affordability, housing, educational costs, all those things. And my worry is that the modulation just swings way over here, and it's going to swing way, it doesn't come back to the middle. It swings way over to the other side. And that for businesses, that's even harder, because I'm trying to run my business and I prefer to be sort of down the middle, or at least have some idea what the variation can be.
And I mean, on that note, if you were advising a bootstrap founder today, what are the top 2 or 3 risk principles you would want them to internalize?
One is the political side. I mean, what state am I in? What county? What city? Because they clearly have very different. One way you could say that's the beauty of the Federation of the United States. That we have individual states and they somewhat can do their own thing. Although again, it becomes when one party's in control, they think federal control is good. When the other party's in control, and so the party out of sorts thinks states' rights has everything to do, and then it flips. So the issues are where are you operating? What state are you comfortable that there's at least some view of consistency in what's going to happen? And I think you're seeing it now where companies are moving states. And I think you as an entrepreneur, you have to be aware. If I'm sitting in Seattle, is that really a place where I can build a business?
And what are you advising them to look at? Because what we would look at is labor costs and availability of talent. If you're going to be if you're not going to be a remote company, and then also there's tax policy, which isn't. I mean, other than incentives for smaller companies and startups, tax policy doesn't have a big effect on most of our companies, if any effect, because they're not profitable, right? So they're not even thinking about what the tax rate is because they don't have a tax check. It's more, access to labor that seems to be, or access to labor and proximity to customers that's driving our customers to make location decisions. If they're not remote, which, almost all of our companies are hybrid or remote. There's very few that are fully in-house unless they're really small.
Yeah, labor's a big issue, and the question is, where is labor going to? And the labor you need, where are they going? In some of these places, I just saw something on the Bay Area where they lost jobs. Now, somebody says, well, during 21, 22, we sort of overinflated. It was COVID, everybody's being remote, and Jesus, demand's going to last forever. So we just hired a ton of people remotely, et cetera. Now with sort of the shift back to hybrid situations, whatever, sort of demand has cooled a little bit. Part of that was just getting rid of some of the over hiring we did earlier. So they lost jobs last year, I think 20,000 jobs, something like that. So now they're looking at it and saying, well, we think we probably hit a bottom, maybe we're going back up. But one of the big things is, how can we attract people into the Bay Area? Because it's so expensive to live.
Right.
So do we need to be in Austin, or do we need to be, Nashville, or someplace that, housing is not outrageously expensive. So I don't see, and then look at the policies. What's the policies of California? Are they doing anything to relieve that? Well, they spend $24 billion on something, but the state accounting for homelessness and housing, whatever else, and the state government's own auditing department can't figure out where the money went, and it didn't do anything. And then housing starts haven't gone anywhere, meaning Newsom was going to really increase housing starts. And that was 6 years ago when he first started. If you go today, they haven't really moved much of anything. So you're looking at that and going, well, housing isn't growing the way it should be. And they're spending money, but it doesn't seem to be having impact on what I need. So do I have a long-term view that things are going to get better? And if I don't, then I just have to look, where are new employees going to go? Because I can't afford to spend $2 or $3 million for a starter house in the Bay Area. So where is someplace that's decent to live, and then my people can actually afford to live? And are they going to migrate there for that?
If you're an in-house company or an in-person company.
Yeah.
When you look over the next few years, what are you most optimistic about?
I think I'm optimistic about productivity gains, because I do think AI is going to drive that. Again, barring some policy decisions that stop that. There's been a lot of angst about data centers and environmental whatever. And I've been listening to a lot of these people that seem to know, they're in the industry talking about it. I think the people doing data centers or whatever have woken up to say, hey, if I'm going to use a lot of electricity, I'm not going to pawn it off on the homeowner down the street. And so now they're talking about, we'll take care of our own energy needs. So this is this Abilene one. They're going to take care of 100% of their own electrical needs and pretty green in the where they're going to do it. And it basically is 100% of their capacity. Now, 99% of the time, they don't operate 100% of the capacity.
Mm-hmm.
So they're going to shoot the excess into the grid so that people in the area can partake in that and, get lower costs. And he likened it to, and I guess in France, if there's a nuclear power plant, if you're within 30 miles of that nuclear power plant, you get free energy for life because they say you're taking some risk. So I think, some people have gotten smart about what they're doing. And I don't think the water, I think they're getting very, very efficient about water and having closed cycles. And they just keep doing it over and over. So I think they're looking at how they minimize the impact, on the area. So I'm optimistic about that. I am somewhat optimistic on AI, that people want to put their heads in the sand and say, I don't like it, don't want to do it. And my issue is, well, okay, then the Chinese are going to do it. And then we're going to be relying on Chinese AI. And I would prefer not to be relying on Chinese AI. I prefer to have our own. So I think we're going to have, good idea there. I do think growth is going to be higher than people think going forward. But so I'm optimistic that way. And if we get high growth, higher productivity, whatever, can we make a dent in our deficits? Because I do think fiscally we're not on a sustainable path. Although I heard this one gentleman say, since the 1700s, and you look at debt to GDP, it's just gone up.
Right.
Over years. So he says it's relative. If everybody else in the world goes to 500% debt to GDP, then you're just part of the part of the group.
It's not going to increase your cost of borrowing relative to other companies, other countries.
But I just get nervous. And the problem is you can't cut anything. Nobody wants to do austerity because the American people, or worldwide, nobody wants to cut anything. Once I get something and it's free, it's mine forever. So then the only issue is, can you grow fast? Can you at least flatten the curve a little bit and grow fast enough to get that 6% down to 3%? They can do that. But the U.S. is pretty tough. I can't say it can't be killed. The innovation spark, whatever that's here, but it's still, I still think it's the most innovative country in the world when it's allowed to be. And I do think immigration is a part of that. And if we can just get control of it, I think the thing is you have to have a controlled border. And Milton Friedman once says you can't have a socialist country and open borders because everybody's going to come. So you do have to control the borders, but you do have to encourage immigration into the country. Right. That's kept this country dynamic and growing, over time.
Well, Marc, thank you so much for your time. It is always fascinating to hear your perspective, and we look forward to the next one.
Great. Well, thank you.
We hope you enjoyed this episode of Bootstrapped, The Lighter Side. To receive future episodes, subscribe using your favorite podcast platform. And if you enjoy this show, please share it with other fellow founders and entrepreneurs. For more insights, helpful tips, and to learn more about founder-friendly financing options, visit us at lightercapital.com. That's LIGHTERCAPITAL.com.